XRP shockwave is forming, not from hype, but from rails, liquidity, and tokenized assets. Finally clicking. Miss the setup and you'll be reacting to candles instead of planning for catalysts. If you only watch price candles, you'll miss the whole story. Most people see green bar and think opportunity, or red bar and they panic. But the real move in XRP, the kind that actually transforms market, won't begin with viral memes or headline hypes. I'll start somewhere quieter, a deeper inside payment pipes, new liquidity flows, real-world tokenization, and fast, stable bridges that move value with the simplicity of a text message. Ignore those critical foundations and you'll always be reacting, not preparing. I'm Kevin. Today, let's break down how a true XRP shockwave could emerge in everyday finance and how you can think ahead, spot genuine signals, and avoid the trap of chasing price pumps after the fact. We'll keep this simple, hands-on, and focused on what delivers actual results: speed, cost, liquidity, and standards. If you ever felt outpaced by crypto headlines, this episode is for you. First principle: utility wins over narrative. Every time price spikes can happen on emotion, FOMO, speculation, influencers shouting the trend, hashtags, those gains vanish unless the system solves real expensive problems. XRP isn't just another volatility vehicle. It was designed from the start for lightning fast settlements and ultra low transaction costs. Where does that matter? Anywhere. Every second counts and every basis point means money. Cross-border remittance, supplier payments that close invoices in minutes instead of days, and working capital that stays usable rather than trapped in limbo. Consider Canadian business sending funds to Asia to pay for supplies. The old process can take days. Rack up fees, hit FX spreads, and leave both sides waiting for confirmation. XRP flips the script. It's always on, nearly instant and programmable. Payments triggered, deliveries, collateral released, and automatic invoice closings right from the ledger. So let's get honest about legacy finance. Today's global transfers often feel as slow as mailing a paper check across the ocean. Banks batch payments for hours or days. Settlement windows slam shut overnight or on weekends. Fees stack up. Small delays turn into big costs. The friction rules. The financial world is moving to a model where payments are live, 24/7, instant and smart. So a single transaction can settle, deliver, invoice, or release funds automatically. Some principal rails before headlines. When big institutions finally shift to new tech, they need more than rising token prices and new hypes. They demand custody compliance, real credit lines, strong risk controls, and deep, reliable liquidity. It's the boring infrastructure nobody brags about. Until one day, massive volume moves and the world realizes the pipes are alive. When reliable rails are in place, huge amounts of capital can flow without breaking policy or workflow. That's when the system wakes up. Now picture XRP as a high-speed connector between banks, fintechs, payments networks, and even a chain market. A well-regulated stablecoin acts as a buffer for volatility. XRP provides the speed, the settlement layer, instead of isolated pools and painful bridges. You get a network value hopping between players almost instantly, predictability, and safely. Good plumbing is quite until everyone needs to move funds fast. Then it's essential. Why does this shift matter so much for XRP? Because a bridge asset's value rises every bit of friction it removes. If going from fiat currency to stablecoin to XRP and finally pays out is reliable, faster, and cheaper than the legacy way capital moves. It's not for hype because of raw math. Businesses pursue lower costs and spread. Treasury teams want more control and predictability. Deliver the real adoption, explodes, ignore, and action stalls. Third principle, tokenization. Real world assets, from fund shares and invoices to government bonds. The settlement IOUs are joining blockchain. But tokenizations only scale if the ledger is fast, stable, and easy to plug in. The purpose, build payment ledgers like XRPs can quietly become the global standard when it stays reliable, delivers low latency predictable fees, and integration tools that matter to enterprises. Doing this boring job flawlessly wins in this domain. When all these prices click, durable liquidity, rapid settlement, and trusted rails, you see compounding effects. Earlier corridors teach the next. Markets shrink, settlements from days to minutes. Lenders gain confidence as collateral actually settles fast and clearly. Corporate treasuries start using on-chain platforms for payables because the dashboards generally improve cash cycles. Volume compounds even if the new makes front page news. You're probably thinking, Kevin, can I actually watch instead of getting lost in social threads? Here are 4 key signals. Real proof points, not just noise. More venues settling with on-chain tools, not just minor prices. Look for exchanges, processors, and marketplace actually settings balance on XRP rails, not just listing tokens. Stablecoin bridges supporting real world capital, not just trading. If businesses use stablecoin, for receivables, payables, or intraday liquidity, and these flows touch XRP rails, that's meaningful utility. Tokenized assets that redeem dependability issues is simple. Redeeming is hard. If tokenized funds, treasuries, or invoices constantly settle and redeem, market trust grows, volumes flow. Enterprises integration, the eliminates manual steps. If a system upgrades genuinely means fewer spreadsheets, emails, and reconciliation errors. Adoption compounds in silence. Institutions don't chase price. They adopt invisible, reliable tech. Let's talk about risk like grown-ups. Crypto can swing 20% in single day. Regulation shift business timelines slips. Your real edge isn't guessing. Tomorrow's scandal is prepping for probable pathways. That requires a smart plan. No matter what price does, process always beats prediction. Here's a simple 4-step roadmap for staying ahead. Track utility metrics. Watch real throughout output. Average fees, settlement times, and integration counts. Stronger metrics equals stronger foundation. 2. Flow liquidity, where all the deepest pools forming. Are they growing? Deep liquidity reduces slippage and invites institutional money. Liquidity is the bridge between hype and actual adoption. Number 3, monitor bridges which stablecoins, rails, and custody solutions connect real businesses to on-chain settlements. Bridges that solve compliance and risk issues will win real capital flow. Think like a treasurer. Cash is business oxygen. If a new workflow delivers faster and more predictable cycles and saves real money, decision makers will adopt and stick with the system. Builders, here's you solve the boring problems: reconciliation invoice, compliance hooks, batch payouts, FX netting, audit trails. The more invisible your tools feel, the broader your addressable market enterprises buy reliability. They don't buy magic. If your integration scrubs out clicks and cuts errors, it will win. Holders hear your strategy. Practice with purpose. Refuse to marry random narratives. Chase genuine transaction flows. If cost drops, speed rises. Liquidity deepens, the tool multiply over investment case is strengthened. If those stall, reduce the risk and hold steady. Simple. You don't have to chase every candle. Just spot when the system is getting fundamentally strong. The three mental scenarios to stay ready. Let's run the three scenarios so you don't get blindsided. Bull chase, multiple corridors to go live, stable coin bridges, get real transaction, tokenized assets settle smoothly, and deepening liquidity catalyst steady price action, and price follows friction. Base case, adoption grows in clear steps. Some wins, some delays. Range bounce prices, but rising floor as the rails turn on. Fundamentals reward patience observers. Bear cases, regulation stalls, liquidity dries up. In that outcome, conserve resources, stay alert to utility signals, and re-enter when fundamentals improve. Plans crash, panic always. Here's why this matters. Payments, settlements are bloodstream of the economy. If a network like XRP keeps moving value faster, cheaper, and light tighten controls, adoption grows quietly until a flood appears. The shockwave isn't sudden, it's years of pipes built under the surface while everyone else argued over short-term price. So does an XRP shockwave actually happen? It can when utility, liquidity, and standards unite. That's about a lottery ticket. If that's not a lottery ticket, it's steady. Honest work across payments, bridges, tokenized rails, when infrastructure quietly hums in harmony. Price characters finally reflect reality, not hype. I'm Kevin in this breakdown. Subscribe for deep dives every week and share with someone lost in candle charts. Leave a comment. Let's keep this conversation growing. Build your plan now before the crowd finally wakes up. Leave your comment so we can keep preparing, not just reacting. When cost, speed, and liquidity markets stop guessing. Build your plan now before the crowd finally notices. Leave a comment so we can keep the conversation going. And thanks for watching.